There's an ETF right now paying over 100% yield. Yes, 100%. It's called MSTY, and it's making monthly cash look effortless. Behind those payouts is a strategy so aggressive it makes traditional dividend ETFs look ancient. So how does it compare to SCHD? Let's do a head-to-head comparison of SCHD versus MSTY. In this video, I'll break down exactly how SCHD and MSTY work, what they hold, how they make money, and what kind of ride you're signing up for. We'll look at income, growth, risk, and run full 30-year projections on what a $100,000 investment could become. And in the end, I'll show you and John how a portfolio of these ETFs can turn a $100,000 investment into a $7 million portfolio that pays over $70,000 in monthly dividend income. Let's start with the basics. What exactly are SCHD and MSTY? First up, SCHD. This ETF has been around since 2011. It's issued by Schwab, carries a super low expense ratio of just 0.06%, and it's a go-to choice for long-term investors who want a mix of growth and income without overthinking it. SCHD tracks the Dow Jones U.S. Dividend 100 Index, which focuses on large-cap U.S. companies with a strong history of paying consistent dividends. But it's not just about dividend history. It screens for financial strength, return on equity, and free cash flow. Basically, it looks deep into the metrics and only picks companies that are both profitable and reliable. Now, MSTY, Yield Max MSTR Option Income Strategy ETF, and this one is different. MSTY launched in early 2024, and it's built around a completely different idea: generate as much monthly income as possible, even if that means giving up long-term growth. It doesn't own dividend stocks. In fact, it doesn't even own stocks. Instead, it uses a strategy based on MicroStrategy, MSTR, a company famous for holding a massive amount of Bitcoin. Here's how it works. MSTY creates a synthetic exposure to MSTR using options. Basically, it uses a combo of buying calls and selling puts to mimic owning the stock without actually holding it. Then it sells covered calls on that position to generate income. That income, paid monthly, is where you get those eye-popping yields, sometimes over 100% annually. But it comes with a catch. MSTY gives up most of the upside if MSTR surges, and it takes on full hits when the stock drops. More on that later. Most of the distributions are classified as return of capital, not earnings, so you're often just getting your money back in pieces. Now that we know what SCHD and MSTY are trying to do, let's zoom in on what's actually inside them, because their holdings tell two very different stories. Starting with SCHD. This ETF holds 103 companies across a well-balanced mix of sectors. It isn't chasing the latest trends, it's sticking with businesses that have long proven track records. The top three sectors are energy at 19.2%, consumer defensive at 19%, and healthcare at 15.8%. That means this fund leans heavily into companies that sell essential goods and services, gas, groceries, and medicine, stuff people keep buying whether the market is up or down. Now, look at the top 10 holdings, and it's like reading a who's who of reliable corporate America. Texas Instruments, PepsiCo, Chevron, ConocoPhillips, Amgen, Cisco Systems, Merck, Altria, Bristol-Myers Squibb, and AbbVie. These 10 names make up about 40% of the entire portfolio, meaning they're important, but the ETF doesn't live or die by any one stock. This kind of setup is what makes SCHD feel like a financial team sport. No single player carries all the weight. It's diversified, disciplined, and intentionally designed for long-term reliability. If the market takes a hit, SCHD has enough balance to take the punch and keep moving forward. Now, on to MSTY. This fund holds just 26 positions, but it's even more concentrated than that. Nearly 94% of its assets are packed into just 10 holdings. But unlike SCHD, MSTY isn't filled with dividend-paying blue chips. Instead, it's built around short-term U.S. Treasuries and a tight cluster of options contracts tied to MicroStrategy, MSTR, a stock that moves almost in sync with Bitcoin. So what does that really mean? The treasuries act as collateral and help stabilize the fund, but the real engine is the options. MSTY uses a strategy that mimics owning MSTR stock through a combo of calls and puts without actually holding any shares. Then it sells covered calls on top of that synthetic position to pull in cash. This setup isn't designed to diversify risk, it's engineered to extract income from a single volatile asset. MSTY isn't trying to diversify risk, it's intentionally concentrated to extract income from one volatile asset. Let's talk about income, because this is where the contrast between SCHD and MSTY goes from interesting to wild. Starting with SCHD, this ETF has a trailing 12-month yield of about 3.74%. That means if you invest $100,000, you'd receive around $3,740 per year in dividends paid quarterly. Now compare that to MSTY. On paper, the ETF looks outrageous, 130.46% trailing yield. That means your $100,000 could be paying you over $130,000 per year in monthly income. Yes, seriously. But here's the reality. Most of that income is classified as return of capital. That's your own money coming back to you in chunks. It's not coming from company profits or business growth, it's coming from MSTY's complex options strategy and capital itself. And there's no dividend growth here. What you get now is what you get later if the fund can sustain it. Now, in a couple of minutes, I'll show you how much each ETF can turn a $100,000 investment into. And in the end, I'll show you how a portfolio of these two ETFs can turn that same $100,000 into a $7 million portfolio that pays over $70,000 in monthly dividend income. Let's shift the focus from income to overall performance, because the real question is how much wealth can these ETFs build over time? Starting with SCHD, over the past decade, it's quietly crushed expectations. In the last 10 years, it's delivered a total return of over 112%. Zoom in a bit, and the story is just as solid. SCHD has posted a 5-year price return of 51.05%, at a 3-year return of 13.18%, despite dealing with rate hikes, inflation shocks, and market corrections. Even in the past year, it's slightly positive, up around 1.5%, while many income funds struggled. Now compare that to MSTY. The fund is brand new, launched in early 2024, so we don't have a long track record, but the short-term performance? It's rough. As of now, MSTY is down over 30% in just 1 year. In the last 6 months alone, it dropped nearly 28%. Even though it's been distributing monster monthly income, the share price itself is in decline. This is classic NAV erosion. When a fund pays out more cash than it brings in, it starts slowly selling itself off just to keep the payouts going. Put simply, you're not getting income, but it's coming from your original investment, not from new growth. And here's the problem. During this period, MicroStrategy stock actually rose, Bitcoin bounced, crypto sentiment improved. So why didn't MSTY ride that wave? Well, it all comes down to strategy, and these two couldn't be more different. MSTY's covered call strategy caps the upside. It sells the potential to earn more in exchange for collecting short-term income. So when MicroStrategy soars, MSTY only captures a slice of that gain. But when the stock drops, it takes the full hit, no cushion, no limit. That creates an asymmetric setup, limited gains, unlimited downside. And that's what makes it dangerous over long periods. The payouts, yes, they can look amazing. But here's the catch. They're mostly return of capital. You're not earning yield on growth, you're extracting pieces of your original investment. Meanwhile, SCHD doesn't rely on clever tricks or financial engineering. It owns profitable businesses that grow over time. When those companies thrive, so does your portfolio. It's boring in the best way, and boring works. What about risk and volatility? The way these two ETFs behave under pressure couldn't be more different, starting with SCHD. This fund is known for its low volatility. It leans into sectors like consumer defensive, healthcare, and industrials, areas that tend to hold up well when the economy wobbles. You're not going to see huge price swings with SCHD, and that's kind of the point. It's designed for peace of mind. Even in rocky markets, it tends to dip less and recover faster. For long-term investors, this kind of stability is worth its weight in gold. Now, MSTY? Let's just say, buckle up. MSTY is tied to MicroStrategy, which is essentially a leveraged bet on Bitcoin. When Bitcoin moves, MSTR moves even more, and when MSTR moves, MSTY moves, with limited upside and full downside exposure. That's a dangerous combo. It's like riding a roller coaster where you can't enjoy the highs, but you feel every drop. And here's another layer. MSTY's income is tied to volatility. When markets calm down, the options premiums it relies on start to shrink. That means less income even when the market isn't falling. So you're not only exposed to price swings, but also a drop in cash flow during quiet periods. There's also the emotional risk. Watching your ETF drop 30% in 6 months while still getting paid might sound okay on paper, but in real life, it's nerve-wracking, especially if you're relying on that income in retirement. A 3% dip in SCHD might go unnoticed. A 30% hit in MSTY could trigger panic selling at the worst time. And then there's the fee. SCHD has one of the lowest expense ratios in the entire market, just 0.06%. That means for every $10,000 you invest, you're paying just $6 a year in fees. It's efficient, lean, and leaves more money in your pocket to compound over time. Now, MSTY, that's a very different story. It charges a 0.99% expense ratio. That's nearly 17 times more expensive than SCHD. On a $100,000 investment, you're paying $99 a year just in fees. And remember, that's before you factor in any erosion from NAV decay or return of capital. To be fair, MSTY's strategy is complex. It's actively managed. The fund team is writing options, managing synthetic positions, and adjusting month to month. That takes far more hands-on effort than SCHD's passive rules-based structure. So the higher fee isn't surprising, but it still matters. Because here's the thing, when you're already fighting NAV erosion, income instability, and capped upside, adding a 1% annual drag on performance stacks the odds even further against long-term growth. Let's put all the theory aside and talk about what really matters. If you or John invested $100,000 into SCHD or MSTY today, what would that actually look like in 30 years? Let's start with SCHD. It has a 7.99% average annual price appreciation, a 3.74% dividend yield, and a dividend growth rate of 10.77%. Here's what happens when you invest $100,000 in SCHD. After year 1, that initial investment will grow to $111,730. After 10 years, it'll be valued at around $317,130. 2 decades in, you'd be sitting on $1,132,316. And if you stay invested for the full 30 years, you're looking at a portfolio value of $4,715,373. That number breaks down into $2.45 million in capital appreciation and $2.16 million in dividends that you've reinvested along the way. And by year 30, your annual dividend income would be $335,936, or roughly $28,000 per month. Now on to MSTY. Same $100,000 investment, but a completely different approach. For our projection, we assumed a flat 15% annual return, coming entirely from monthly dividend payouts with every dollar reinvested. Why 15%? Well, MSTY's current yield is sky high, over 100% annually on paper, but as we've seen, much of that income is classified as return of capital, and its share price has dropped over 30% in the past year alone. That's not sustainable. When you factor in volatility, option premium decay, and long-term NAV erosion, it's clear the fund can't maintain triple-digit yields forever. So 15% is a balanced middle ground. It reflects the fund's short-term income-generating power while acknowledging the structural drag of high distributions and a flat price chart. No fantasy compounding, no optimistic dividend growth, just consistent reinvestment of cash flow at a level that feels aggressive but grounded in how the strategy actually works. Based on this rate, by year 1, MSTY will grow to $115,000. In 10 years, it'll be valued at $404,556. After 20 years, it'll be at $1,636,654. And at the 30-year mark, the portfolio hits $6,621,177. And around that mark, it'll be paying you $863,632 annually. That's over $71,969 per month. So on paper, MSTY is the winner. No contest. It turns $100,000 into over $6.6 million and pays nearly $72,000 per month in income by year 30. That's more than most people make in a year. But would I personally invest in it? No, and here's why. MSTY isn't generating wealth, it's extracting it. The income feels amazing, but it's not coming from business profits or compounding growth. It's coming from a high-risk option strategy wrapped around a single volatile stock, and most of it is return of capital. The fund is slowly selling itself off to make those payments. There's no reinvested momentum, no underlying strength, just engineered cash flow and declining NAV. And honestly, who can be sure it'll even be around for 30 years? But that doesn't mean that MSTY has no place. Personally, I wouldn't make it my core holding, but in the right portfolio mix, it could be a powerful income booster. Combine MSTY's monthly payouts with SCHD's long-term compounding power, and you might end up with the best of both worlds: consistent growth and real cash flow. Here's what that portfolio would look like with a 50-50 split. When combining both, the portfolio will have an average dividend yield of 9.37%, combined dividend growth of 5.39%, and an average share price appreciation of 4%. Based on these metrics, after just 1 year, your portfolio would grow to $113,370. Fast forward 10 years, and it'll hit $369,997. At the 20-year mark, the portfolio will be valued at $1,557,064. And by year 30, you'd be sitting on a portfolio worth over $7,581,001. while earning $898,474 in annual dividends, or nearly $75,000 a month in dividend income. So the total value added from that $100,000 investment would be $7.48 million, with $5.7 million coming from reinvesting and $1.76 million from capital appreciation. Want to know how to make $7,000 a month with only $20 a week? Click the video on the screen to find out.